Again, I'm Dale Caldwell. This is what we call Family Business Friday, our Zoom at noon program. Um, um, Brian is going to talk about, there's this little thing called an election that just happened, and talk about what does that mean for small businesses and where are we going to go from that. But before, I want to just introduce people who've not heard of the Rothman Institute, who we are. So our mission is to support, promote, and research entrepreneurship with a very special focus on family and veteran businesses. And we work with students and other things. But we really are trying to be one of the major voices, along with CIA&J and other groups, of entrepreneurship, not only in New Jersey, but nationally. We wouldn't exist without our sponsors: TD Bank Charitable Foundation, Provident Bank, SunTrust, CIA&J. We have some other veteran launching ventures sponsors as well. One of the things that we're most proud of is that we actually created Family Business Week, which is the 4th week in October. We're encouraging people to support family businesses throughout the year, but during this special week, we are trying to call attention to family businesses. So our website is familybusinessweek.com. And we also created a website called Shop Family for folks, and a lot of restaurants have been struggling. It may, given what's happening now with the increased rates and going into the winter, it's going to be a tough time for restaurants. So this is an opportunity for people to buy some gift cards and use the cards when the restaurants are open again in the spring. I do a TV show called Family Business World. Tony was one of my featured guests, where we have a conversation with different family businesses and experts who work with family businesses. Brian is going to be a guest on the show in December. And so it appears every Thursday at 10 a.m. and 8 p.m. I also heard that today I found out they actually will have a channel on Roku. So anybody who has Roku, there will be actually a RVN TV a channel. Again, our Family Business Fridays, our weekly Zoom call, which has been very, very well received and attended. Another of our programs is our Veterans Launching Ventures program. It's an 8-week program where we take veterans or immediate family members of veterans through the process of developing a business plan and then helping them make that business plan a reality going forward. And right now, we have become international. We are doing it via Zoom, obviously, and we have folks from 10 or 11 different states, but also someone from Germany had participated in the program. And our website is veteranbusinessworld.com. This is, and we want to encourage you, this is the Rothman Institute of Entrepreneurship Facebook channel, a YouTube channel. And so we'll have this video as well as other videos on here. So if you missed this, or you heard another one was good, you can go here. It has the Family Business World TV show, but it's a great resource with literally hundreds of videos and a lot of really, really good information from amazing guests like Brian and Tony. And then, as some of you had heard, we had our annual, actually our 28th Family Business of the Year award. And so our award winner, Laura Mashtaler from Black Swan Espresso in Newark, was our new Family Business of the Year award winner. They were on our show, our last Friday show. The award winner, Dennis McCullough and McCullough Contracting, are under 10 million in sales. And then our over 10 million in sales is Mike Seitel from Norwalt Design. And these businesses are amazing. We're trying to get more and more nominees for next year for our 29th. And we're hoping, against hope, that we will do it in person. So with that, I want to introduce Brian Singleton, who is an expert in a lot of different areas. He has multiple degrees. Brian, you have, you're an expert in accounting and the law. How many different degrees do you have?
I think that the one that was most expensive is my law degree. So we'll go with that.
No, but you've been very good. Now you have, you can share. So you have a PowerPoint that you want to go through.
Yeah. And thanks for the nice introduction, Dale. Thank you, Sue. Thank you, Tony, again for having me. I'm looking at the participant list and I see a lot of familiar names. So it's great to talk with everybody and hopefully, I give you some gold nuggets and some takeaways It might be a little tougher now than in the past, but I'll see how I can do. Dale, just to orientate myself, how long do we have?
So we end promptly at 1. So we'll mix in, if you don't mind. I'm going to interrupt you and ask some questions. We are encouraging people to send questions either through the chat or the Q&A. And if I see that or Sue sees that, then we'll ask you those questions. But it will be a kind of an interactive thing. So really, you started off, and I'll be rude and interrupt you if I don't understand something.
Sounds good. So I'm an attorney. My firm, we focus on tax, estate, and closely held business matters. So that's all we do. We stay in our lane. We do it really, really well, and we don't veer out of our lane. So today I'm going to talk, the title of the presentation is how COVID-19 and the elections will impact business owners from a tax perspective. I'm going to start with, we really don't know a lot of what is going to happen when it comes to taxes. I've learned over the last 20 years or so, my crystal ball isn't quite that clear. When it comes to Washington, everything is for sale, right? We know that there's a lot of gridlock and a lot doesn't get done, but we also know that everything is for sale and compromise can happen. The one thing I do know is that there's a lot of noise in the media, right? So you hear a lot of different stuff. It's never 100% accurate. So what I hope to accomplish today is I'm going to share facts about how the political process operates and how that impacts taxes, right? So I'm going to talk a lot about how the political process operates and how that impacts taxes. So there are certain things that are happening right now in the marketplace. I was talking to Dale a little bit before this, and I said, I'm seeing with our corporate clients, it's either feast or famine, depending on the industry that the clients are in. They're either doing really well or they're starving. There's not a lot of middle ground, at least that's what I've been seeing. I've also been seeing significant estate tax planning being implemented, significant. So I brought on a partner within the last year. He's a brilliant tax attorney. He and I are completely inundated right now with estate tax planning, and we're looking at hiring 1, maybe 2 additional attorneys because of the activity that's occurring with estate tax planning. So I'll talk a little bit about that as well. The agenda today, I want to talk about the COVID-19 impact on the national and state debt. I'm going to review at a high level current tax law. I'm going to talk about the impact of the elections and what we can expect, and then I'll share a couple planning opportunities. If you're everybody's sitting in front of the computer, you don't have to do it now, but if you Google usdebtclock.org, it's going to show you, it's a running tab on various financial indicators. And if you look at the upper left-hand corner, you see the U.S. national debt. This is, of course, a static slide. I think I took this screenshot at the beginning of this week, maybe Monday or end of last week. And you see the U.S. national debt at $27 trillion. If you looked at this debt clock 6 months ago, that number would have been about $21 million.
Wow.
So as we know, what's occurred over the last 6 months with COVID, we've had the PPP, we've had the economic stimulus packages, and we've had various bailouts. We're also, they're also looking at another round of stimulus after that. The debt's going to be about $30 trillion. So we're up about 30% in just 6 months.
Is this record, Brian? Is this record? Is that a record amount?
Yeah. I think we continue to set records every day. I'll take that back. I'm not sure. I know that we've spent down the debt. So that's a Google search question, but I'm not sure, but it's high, right? And it's a record as far as increasing the national debt in such a short amount of time. Right. And we know why that's occurring, right? that's happening not just at the federal level, but also at the state level.
Right.
And we know there's two ways to address this. You either cut spending or you increase taxes. Income taxes are at historic lows. Estate and gift tax exemptions, which I'll talk about, are at historic highs. When it comes to the estate and gift tax, we know that under current law, the estate and gift tax laws are going away no matter what. They go away under current law on December 31st, 2025. But they could likely go away earlier, and we'll talk about that. State debt.
Brian,
Yeah.
I did the Google search. It says 120.5%. The U.S. national debt has just reached 120.5% of the nation's annual economic output, breaking a record set in 1946, highest debt level in the history of the United States. So
there we go.
From a reasonable source.
Thanks to good, we Googled it.
It works, yeah.
So we know that the national debt's all-time high. State debt is very high. How does the state raise money? Well, they increase taxes, or if they don't increase taxes, they audit more. Now, the auditors are up to their ears in alligators. They always have been, but you can also see, wouldn't be surprised to see increase in corporate and also individual income tax audits, especially for high earners. Mm-hmm. All right. So it appears that Joe Biden and Kamala Harris will be the next president and vice president. If we look at the presidency, then we look at the House. We know that the Democrats control the House, and the Senate is still up for grabs. And this becomes especially important as it relates to President-elect Biden's tax policy. So I want to take us back, briefly to social studies class or political science class, and talk about a couple items that you don't hear a lot about in the media, but are very critical. So the first starts with the Senate. There's a law in the Senate that any senator can filibuster any bill. In order to override a filibuster, you need a 60% vote in the Senate to override that filibuster. So that can be a way to stall out legislation. There are two exceptions to this 60% override law. The first exception was a law passed by Republicans during the Obama administration, and it only requires a simple majority in order to appoint federal judges, bankruptcy judges, in order to appoint judges. So that's one very powerful exception. It can allow a simple majority of senators to appoint judges. So that's very powerful. The second exception to the rule is a budget reconciliation bill or a budget reconciliation act. This is how the 2001 Bush tax cuts were passed. If you remember back then, it was a 50-50 tie in the Senate, and then Dick Cheney, as the vice president, stepped in to cast the deciding vote to implement the Bush tax cuts. A budget reconciliation bill and then act was also how the Trump 2017 tax cuts passed. So what's important to know is that as it relates to taxes, which generally are addressed in budget reconciliation bills and acts, you would only need a simple majority of the Senate in order to pass that type of bill. And as we know, in Georgia, we have two runoffs. In order for there to be a 50-50 tie, 50% Republicans, 50% Democrats, actually it's 48. We have two independents, but those two independents caucus with the Democrats. But in order for it to be a 50-50 split, the Democrats would have to win both of those seats. So I'm sure everybody knows by now, but just to reiterate, the way Georgia works with their elections, if you don't receive a majority, over 50%, they have a runoff. The runoff's on January 5th, and that's going to decide who holds those two Senate seats. So if the Democrats were to win both of them, then we know that there would be a 50-50 split. If the Democrats do not win both of them, there can still be significant tax policy implemented. President-elect Biden would have executive authority to issue regulations. One of the most important cases that's ever been decided during our lifetimes is a case called EPA v. Chevron. So in EPA versus Chevron, the Supreme Court ruled that a federal agency and federal judges have to follow a regulation promulgated by an agency in charge of statute unless there's a finding that the regulation is arbitrary and capricious. What that means in English is the president has significant power to issue and drive regulations. And in order not to fall, there's even court precedent where a regulation was completely conflicting or contradictory to the underlying statute, and the Supreme Court found that it was not arbitrary and capricious. So the president almost has a type of legislative authority, and that includes over taxes, through the Treasury. So whether it is through legislative action or the president's power to issue regulations, we're most likely going to see some type of enormous changes when it comes to taxes. All right. And this slide here, I'm going to go into a little bit more detail what some of the president-elects and the party's tax policy proposals have been. But from a general standpoint, they've talked about additional payroll taxes. They've talked about increases on taxes for individuals making more than $400,000 a year. They've talked about increasing the capital gains tax rate for high income earners. They've talked about increasing the corporate income tax rates, and they've talked about increasing wealth taxes. So something I get a fair amount of questions around is, Brian, could something be implemented retroactively? Because under conventional thinking, the President Biden becomes president in 2021. Whatever happens with the Senate happens with the Senate. So if any changes were to occur, they wouldn't occur until January 2022. That's not always the case. Congress may have ability to enact retroactive tax legislation. In fact, we've seen it twice over the last 25 years. I won't bore you with the test, but the test is, retroactive taxation of transactions is authorized if the changes are rationally related to a legitimate legislative purpose. The critical language there is rationally related to a legitimate legislative purpose. That's a very low standard, and the legitimate legislative purpose would be raising revenue and having the authority to tax. So just know that it could be possible for retroactive legislation to be implemented. Let's drill down around some of the Biden tax proposals. So I talked initially about tax increases for those earning over $400,000 of income. What does that look like? So they've talked about restoring the 39.6% individual marginal rate. The current highest individual marginal tax rate is 37%. So they've talked about increasing that to 39.6% and having that become effective after $400,000 of income. So especially for the business owners on the phone that have flow-through entities. So you're a corporation and you've elected to be taxed as an S corporation. You're an LLC or a partnership, and you've also elected for flow-through taxation, whether you've made an S election for your LLC or the traditional, you're being taxed as a partnership. or you're a disregarded entity and your tax is a sole proprietorship, all of those tax statuses, your profits and income pass through to your individual income tax return. Right. So if you're over that $400,000 income limit, you would expect that your income taxes, or at least under under Biden's proposals, that'll increase to 39.6%.
Brian, let me, so, I have my own consulting firm. I do this, but I write off all and that 400,000 is after all write-offs of expenses, et cetera, right?
Correct.
Okay.
Correct.
And how do they come up with 400,000? In New York and New Jersey, 400,000 isn't necessarily a lot of money. In Mississippi, it is a lot of money. How did they come up with that number?
It's a great point. And it especially impacts, right, us here in New Jersey, on the coasts, right, the right coast and the left coast, but especially as we sit here in New Jersey and New York, that's a pretty low threshold, and there's a lot of people in this area making at least $400,000 a year. It's especially if you look, if they're married and you combine two sources of income. So it's almost unfair.
Brian, there are people paying that in property taxes in New Jersey.
Oh. Right. Yeah. In New Jersey and New York. So, it's skewed, and it's definitely skewed against us here in New Jersey. And you're going to see a lot of these tax proposals were tied to this $400,000 number. Before I really started drilling down around the proposals, I would hear President-elect Biden I'd hear him talk about three things and all the sound bites whether I saw him speak in the debates or, I saw him speaking on any of the other programs. He talked about increasing taxes for people making over $400,000 a year. He talked about increasing corporate income tax rates, and he talked about having wealthy people pay more money when they died. Those were the three sound bites that I heard over and over and over again. So it really concerns me, as a tax attorney when it comes to that. So, the next bullet point here, restoring the 3% piece limitation and cap the itemized deductions benefit to 28%. What that ultimately does is it caps the amount that you can take as itemized deductions if you itemize your deductions. They talked about adding a new section 199A phase out. And again, the threshold number on that is $400,000. They talked about eliminating or limiting section 1031 like-kind exchanges. So for anybody on here that invests in real estate, whether as a primary business activity or a secondary business activity, they're talking about eliminating the ability to do a section 1031 like-kind exchange. And to keep it simple, you take your current property and you sell it, you purchase a new property. You do not have to recognize a taxable event at the time of the sale. Effectively, you carry the cost basis over to the new property. And then if you ever sell that new property, that's when you would recognize the taxable event. Or if you die owning that property, you used to be able, you can get a step up in the cost basis, and you can transfer that capital appreciation. You get a step up to what the fair market value is at the time of death. But I'm going to talk about that more on the next slide. And then an additional, they're talking about expanding the 12.4% Social Security tax. This would also apply for us business owners to the self-employment tax if your self-employment income is over $400,000. So I've gotten a lot of questions around this. The way that it's being proposed is that currently that 12.4%, since most of my clients are business owners and this is the Family Business Forum, right? We pay that on self-employment income up to the Social Security wage base, which is currently $137,700. The proposal is that any income between $137,700 and $400,000 would not be subject to the Social Security tax or the self-employment income tax Then on any dollar over 400,000, you would now be subject to that 12.4% tax. That's significant. And that would be under the current proposals to infinity and beyond. Right? There's no cap on that under what's been talked about.
Brian, can I ask you this question? Is there any way, because so often we hear people say, raise taxes on all millionaires, and other people say reduce taxes on all millionaires. Is there, and I say, well, maybe the answer is something in between. Why not reduce taxes on job creators like family businesses if you create jobs? Is there any tax way to do that? Has anyone proposed that? You know what I'm saying? That if you're creating jobs, you should have a tax deduction.
I haven't heard of anything specifically like that being, proposed or talked about that has any, teeth more. And if you have, jump in, because I'm not the all-knowing.
No, I haven't. That's
yeah. Yeah. No, I haven't heard of anything like that per se, but it sure makes sense to me, right? I think that question goes to the core of why you want to provide certain tax benefits to business owners.
Exactly.
Right? Because we're the ones that are creating employment opportunities. I mean, I think they say that 90% of the workforce is employed by all of us on the phone, right? By the closely held, quote unquote, small business owner. And we want to make it. Listen, if I'm growing and everybody here is growing, that means more people need jobs, right? And tax policy. And tax policy factors a lot into that, and then this touches on, that's where the political nature, right, can come in between, trickle down economics, tax the rich. And I don't want like any politicians, whatever side they're on. I hate them all, but, so that's a good observation.
Now one of the attendees was saying that when a business hires people, they get to deduct the cost, which works to reduce the business taxable income. It's accounted for, but I'm saying on an ongoing basis that if you hire, if you maintain people and you're continuing to maintain people, and so Joey, but you're absolutely right that there is a deduction when you hire, but. So I don't want to slow you down, Brian, but
it's still there's a deduction when you hire, but there's still a cost, right? Right. So you have to have that $100,000 of, if you're paying somebody $100,000, you would have put $50,000 in your pocket. I'm just assuming a 50% all-in income tax rate because, I can do simple math like that. You would have had $50,000 in your pocket. And although you took the deduction for the 100, you lost the 50,000. So, right. So let's, I'll keep going here. Then let's talk about the capital gains taxes. So they're talking about any capital gain that's greater than $1 million will be subject and treated as ordinary income and be subject to that 39.6% rate. This is absolutely significant, especially when we're talking about a liquidity event or a business exit plan for a business owner, right? Whether it's a sale to a family member or it's a sale out in the marketplace, your tax rate just doubled, right?
So Tony, you have your camera on. Tony has a question for you.
Yeah, thanks, Dale, and thanks, Brian. And just a quick question on this point. I was talking to one of our financial members, and they had read or they're hearing that a lot of people are going to start moving money overseas, to avoid these kind of taxes. I mean, do you agree with that?
Yeah, no, I 100% disagree with that. So my firm, we do a lot of international estate planning. We do a lot of international, well, let me hedge that a little bit. I do a lot of international income tax planning, and you say, okay, if you increase taxes here in the United States, maybe we'll go to Ireland and we'll set up a C Corp in Ireland and take advantage of their their very low corporate income tax rate. The problem for a lot of small businesses, if you're still here in the United States, you can run into significant problems even prior to President Trump. You can run into onshoring problems because although I might set up an entity in Ireland, if I am a United States citizen and I take a dividend distribution from that Ireland entity, well, I'm subject to pay taxes on it here in the United States. So I can minimize taxes as long as the money stays in Ireland. So that was even prior to Trump. After President Trump, he passed a series. There was a lot of legislation was passed that made it even more difficult. So in theory, offshoring, so we're kind of constricted around that, and it's more, and for more of the small business owners, done a lot. Always historically did a lot less kind of international planning, and Trump made it even harder. Not to say that that's not going to open up more, but I think as a general, as a general statement, I would say that that's not a big risk that I would be scared about. Put it that way.
All right, and just a follow-up question. I mean, the capital gains taxes right now, what would be the rate?
20%.
Wow.
So this doubles.
It doubles.
So think about the impact to the markets, right? I mean, if you're an investor, I mean, you're paying just on $1 million, you're paying 400,000 back in taxes. I mean, what do you think that does to the market? The markets, I should say.
Yeah, it's significant. It's significant, and it's also significant for everybody on the phone and for family business owners if you're thinking of an exit plan, right? And I'm going to talk about some kind of basic strategies to address this, and then also some of the more kind of sophisticated strategies to address it. But you're doubling the tax rate, right? So if I'm a business owner and I'm under, I have a purchase agreement that I'm going to close on January 5th, 2021, should I seriously be considering moving up the closing date to fall within 2020 just in case? You betcha. I absolutely would. Again, I said my crystal ball isn't quite that clear. I don't know we don't know what the heck's going to happen next year. But if I knew that I was closing the first week of January, listen, if that tax rate could double if I close in 2021 versus in 2020, let's move the closing date up so it occurs in this year. Now I get it's almost, if you're going under LOI or you're in the due diligence process, there's not enough time to say, hey, we want to close in 2020. But if you're through a lot of that and you have a closing that's set for the first couple of weeks in January, maybe think about moving that up to into December just in case. So right. It's significant.
Thank you.
Significant, and especially impacts closely held and I'll call it small businesses.
And just real quick, I want to slow down too much, but so say there's a Republican Senate, and you have Biden and Harris in the White House. Now, can this be passed, or are they at a stalemate?
So that kind of goes back to those preliminary slides. Right. So if we have a 50-50 split in the Senate, meaning the Democrats win, both Democrats win Georgia, then that could be very easy, much easier to accomplish, right? Because effectively the Dems would hold the presidency, the House, and then the vice president would have the tiebreaker. So that case, yes. The second instance where it could occur, some type of compromise right? Don't forget about compromise. I get that there's a stalemate, but like I said before, everything's for sale. So you give me a little bit of this, I'll give you a little bit of that. So does it mean that all of these tax proposals would get passed? No, not necessarily, but some of them could as part of a greater compromise. That's generally what happens. And then the third way that it potentially could be passed is through some sort of regulations issued by the president. So, and there's kind of more ambiguity around what could or could not get passed if that's how it was being done.
Thanks.
I know that doesn't directly answer the question, and a lot of it's because we don't know, but those are kind of the three ways that any of these proposals could become law.
Great. Thanks.
Okay. And then, so that the capital gains tax, that's a significant one. And then also increasing corporate tax rate from 21% to 28%. This impacts C corporations, right? I'd say probably 70% of my clients, and I don't know what market statistics are, but 70% of what I call small, closely held businesses are some type of flow through. So corporation taxes and S Corp, LLC taxes and S Corp, or as a partnership. Then the other 30% are taxes is traditional C Corps, and they're talking about increasing the corporate tax rate from 21 to 28%. Mm-hmm. All right. I'll come back to that. So what about the wealth taxes? This is, you're referred to the death tax. It's the federal estate tax, the federal estate and gift tax. So let me first start with, because I get this question a lot. New Jersey does not have an estate tax. So the bill that was signed into law by Governor Christie, it was about 4 months before he left office. It's the same bill that increased the gasoline tax, is also the bill that effectively repealed the New Jersey state estate tax. New Jersey still has what they refer to as an inheritance tax. The inheritance tax is only, it is due if the person inheriting property from the deceased is not a Class A beneficiary. A Class A beneficiary is a spouse, children, grandchildren. If you're leaving your assets to your spouse, your children, or your grandchildren, you do not need to be concerned because there is no inheritance tax. If you're leaving money to a niece, a nephew, the kid next door, then there is an inheritance tax. The top rate is 16%. Most people, none of it, we all want to pay as least amount of taxes as possible, but most people don't care if the money's going to, the kid next door, or niece or nephew. They're not as concerned about it. So for most purposes, we don't need to worry about a New Jersey state estate tax, but we do need to be concerned about a federal estate tax. Under current law, the federal estate tax exemption, the amount of assets that is not subject to a federal estate tax levied by the Internal Revenue Service is $11,580,000. If your estate is greater than $11,580,000, there's a tax rate applied of 40%. The tax is due in cash. It's due in 9 months. The IRS does not want your business. They don't want your real estate. They want tax. If you're married in a legal marriage to a United States citizen spouse. Resident green card holders do not qualify. If you are married and you have to be legally married to a United States citizen spouse, you can pass an unlimited amount of assets free of any federal estate tax to that spouse. When that spouse dies, that's when the estate would be subject to the federal estate tax. If you are married, you can effectively double that $11,580,000 exemption. So let's call it $23 million. That's under current law. On December 31st, 2025, that law sunsets and the federal estate tax exemption decreases to $5 million per spouse They increase it for inflation going back to 2010. Congress doesn't like to make anything too simple. So it effectively will be somewhere around $6 million per spouse in 2026. That's under current law. All of the Biden tax proposals have talked about decreasing that federal estate tax exemption down to $3.5 million. Okay. Hopefully, that would be per spouse. So we'd have a total of $7 million. I will tell you, living in this area, again, going back to living in this area, there is a huge difference. And there are so many more people that are impacted, decreasing this from, let's call it $23 million for a married couple down to $7 million for a married couple. This touches and impacts a lot of people, and it impacts a lot of closely held business shareholders. They've also talked about, in addition to decreasing the federal estate tax exemption, the federal gift tax exemption. So as we sit here today, the gift tax exemption is equal to the estate tax exemption. So that $11,580,000, effectively, if you can either use it today in the form of the gift tax exemption, and anything that you would use in the form of the gift tax exemption is subtracted from your federal estate tax exemption. So you use it today or you use it when you die, right? To keep it simple. So they're talking about now decoupling the estate tax exemption and the gift tax exemption and making the gift tax exemption only $1 million. So what that would mean is for families that made gifts to children, made gifts into trust for the benefit of children, future descendants, you would be limited to a value of $1 million to do that. That is also significant when it comes to estate tax planning. All right. They've also proposed increasing the federal estate tax rate. The rate that I keep hearing is somewhere between 50 and 60%. And the last bullet point here, and this has been talked about a lot. This was actually talked about by President Trump, but never really made it anywhere. And that was eliminating the cost basis step up at death. So I referred to this before. If I buy an asset for $100 and that asset increases in value to $200, when I die, the cost basis of that asset is stepped up to the current fair market value of $200. So whoever inherits that, whether it's my spouse or my children or a trust, they take the cost basis at whatever the fair market value is at my date of death. If that descendant turns around and sells the asset, let's say they sold it the next day, they would not have to recognize any taxable gain because you receive that step up in cost basis. This becomes especially pertinent to family-owned businesses, right? Every time you transfer that asset to the next generation, that next generation gets a step up in cost basis. Under the current proposals, there would not be a step up in cost basis. There's been two different ways that they've talked about handling it. They haven't got a lot of clarity. We don't really know, but there's two ways that it could be handled. The first is how Canada handles it, and that's realizing the gain at death. So if I bought an asset for $100, it's appreciated to $200. I die. Upon my death, my estate would owe a capital gain based on the $100 increase in value, right? It would have to be paid at that time. So that would be one way that it could be handled. The second way that it could be handled is by utilizing carryover cost basis. So the taxable event does not occur at death, but the cost basis, that $100 cost basis is carried over. So now my son or your descendants take that asset with the original cost basis. So when or if they ever sold the asset, that's when the taxable event would occur. But that's also a very significant, that's a very significant change. And you would think that they wouldn't have, back in 2010, the federal estate tax was repealed for 1 year. but but there was no step up in cost basis, and they provided you a certain amount that each spouse could utilize. It was somewhere around $3.5 million of cost basis step up. So we would hope that they would provide some type of, amount that you could utilize for cost basis step up, so it doesn't impact everybody, right? People that are worth 200,000 or 500,000 or $1 million. But we also know that the government needs money, kind of tying it all in. So, but this is one that's been talked about heavily, in eliminating the cost basis step up at death. All right, so that's an overview of some of the income tax proposals that have been talked about, and also the estate tax proposals that have been talked about. In my next couple slides, I'm going to talk about just some general, what are some different income tax planning ideas if we think that the income tax rates are going to increase in 2021 or 2022 up to 39.6%. So, the simple one is accelerating income into 2020, right? If you've ever, Roth conversions, this is one where I'm sure everybody on the phone has heard somebody talk about it. This is one of those planning ideas that everybody, it gets talked about a lot, but I don't see a lot of people actually implementing around it. Although there are a couple specific situations where it makes a lot of sense. But a Roth conversion is you take your traditional IRA that's subject to income tax when you make distributions, and you convert it into a Roth IRA. A Roth IRA, after it's converted, you never have to recognize income tax either on the growth or the distributions made from the Roth IRA. But when you convert it, it's an income taxable event. So if I have a $200,000 IRA, I convert it to a Roth IRA. In the year that I convert it, I have to recognize a gain, or I have to recognize the $200,000 as ordinary income. So if you've been thinking about that, thinking about doing that in 2020, harvesting gains. I mean, this goes to, if you have a large gain, you think income taxes are going to increase, especially if you're a high earner, and the capital gains rate's going to double to 40%. And it's currently 20%. If you have a business interest or highly appreciated stock or highly appreciated real estate, thinking about harvesting those gains in 2020. If you think tax rates are going up, well, let's pay tax on a lower amount. Deferring loss harvesting, it's common in investment portfolios to offset to take losses, to offset them against your gains. Well, if you think income tax rates are going to go up or increase, well, let's defer that till 2021 or 2022. These are general in nature, but to kind of give you a mindset to think about what are some of the things that can be done. Deferring business expenses, right? If you have a large business expense, let's defer it into a year when tax rates are higher, right? Deferred compensation payments, stock option planning, right? These are more for executives. Maybe if you have a C corporation, you have a deferred comp plan in place, but taking those payments this year when tax rates might be lower, and then selling assets now that have a large capital gain. So just some general ideas and concepts to think about in order to minimize your taxes. This next slide, I don't want to spend too much time on this. This is more of, these are some more of the sophisticated planning strategies. So an installment sale to a non-grantor trust. I'm doing a couple of these right now.
Brian, a question. We have a question.
Yeah.
Can we share our slides? Can we share slides with the attendees?
Yeah.
Okay, perfect. Okay. Yep.
Okay.
Brian's going over a lot of great stuff, but those of us that aren't CPAs may not capture all of it. So we're gonna have to look at the slides again. So
yeah, no, and I'm trying to keep it as high level as possible, but some of it we got to get in the weeds because it's taxes. Feel free to you can feel free to share any of these. The attendees can feel free to share them as well. I have no problem with that, but thank you for asking. So this slide, I'll talk about a couple of these real quick, but installment sales to non-grantor trusts. If I'm at the call in the middle of or at the end stages to selling my business, we do a lot, in addition to the estate tax planning, we do a lot of corporate transaction work. And then we tie in the tax planning with that when we can. So if I'm selling my business, but listen, I'm not going to be able to sell it by the end of the year. A planning idea is to set up a non-grantor trust. It's a separate entity, and you can sell your business to the non-grantor trust. If you do that, effectively you're selling it to in a sense, you're selling it to yourself. Maybe you set this non-grantor trust for the benefit of your spouse, or you set it up for the benefit of your descendants, or your spouse and your descendants, whatever the case may be. You sell the business in 2020, that's going to generate a capital gain under 2020's long-term capital gains rates of 20%. Then in 2021, whoever the third party was that was going to purchase that you're in negotiations to purchase, they consummate that sale in 2021. Okay, so they're buying it from the trust. Well, because you've already generated the long-term capital gain, you owe that tax based on the 2020 tax rates. So it's a way to accelerate. And make sure that you're operating under the current 20% long-term capital gains tax rate. Now, there's risk to that, because what happens if that sale to the third party isn't consummated in 2021? You still owe the tax. So you better have the liquidity to pay the tax if all things go wrong, because in the transaction space, things go wrong. But it's an interesting idea to accelerate and keep the 20% long-term capital gains tax rates. Charitable contributions of appreciated property can be a way to receive income tax benefits. That occurs in 2020 if the income tax rates go up or the long-term capital gains rates go up. If you're charitably inclined, making an offsetting charitable deduction can offset some of that gain that happens in a year where you have large amounts of income. I will tell you, and there's a lot of advisors out there that promote different charitable strategies. I'll just tell you from a basic standpoint, if you're not charitably inclined, you're always better off just paying the taxes and keeping the asset. I'll keep it real simple, right? So there's a lot of different charitable strategies out there, but for those that are charitably inclined, there's a lot of great things that you can do to offset gain, both from an income tax planning standpoint and from an estate tax planning standpoint. So I know that the people on the phone have some, relationship. They went to FDU. That can be a way you want to really help out FDU and the Rothman Institute. There's a lot of great things that you can do, and there's a lot of great tax benefits to making those types of charitable contributions to help an organization that you're involved in, but also to receive some great income tax and estate planning benefits. So keep that in mind.
Thank you, Brian.
There's a lot of things that you can do. So keep that in mind when you're talking to your CPA and you're talking to your estate planning attorney. Think about making some type of contribution to FDU and the Rothman Institute, because it can help you out, not just from the goodness of your heart and helping out the organization, but it can also help you out from, in your pocketbook, and put more money in your pocket, in your descendants' pockets. Tax-free exchanges, if you're thinking about that, let's consummate that transaction before it might go away under some of the proposals. Investing in opportunity zones. This is kind of a recent development. My partner is an expert in opportunity zone investments. you need to be affiliated. We do a lot of them, but you need to be affiliated with somebody that can identify if it's a good investment. We help out from kind of the structural standpoint in the tax planning of those types of transactions, but you need to know somebody and be involved with somebody that really knows, if you're making a good investment. And then wings, nings, and dings. So these are, you set up a trust in a state that does not levy a state income tax. So we also know that, New Jersey has one of the highest state income tax rates in the country. And they also increased that on individuals making more than $1 million. So it increased even more than New Jersey millionaires tax. One of the more, if we set up a trust in a state that does not levy a state income tax like South Dakota, and you own assets in those trusts, then the assets that are held in trust are not subject to state income tax. So I don't want to get into too much detail around that because that can go pretty deep, but just know that there's some different things that you can do out there if it's the right fit. So that's the income tax. That's the income tax planning at a high level.
Brian, we have about 5 minutes, so
We're perfectly on time. So, a lot of the income tax plan, there's some planning that you can do, but also working with your CPA, make sure you're taking advantage of all the deductions. CPAs work on a continuum, right? From being, the continuum's your continuum. So although a tax attorney, I'm very conservative when it comes to at least my income taxes, right? And so, I'll have conversations with my CPA on, I'm taking this deduction. Here's the amount that I'm taking. What's my risk there? Everything works on a continuum from being very conservative to being very aggressive. Now, for clients, I always have that conversation with them. There's some things that we can do that are very aggressive, but can potentially save you significant amounts of income tax, but what's the risk? The risk is you go under audit and then you got to hire us to defend you under audit. But even under audit, if you can settle with the auditing authority, whether it's the IRS or the state of New Jersey or New York City, whoever it might be, it can still be a win even after paying legal fees. Now, I would probably say a lot less percentage of our clients, have that high of a risk of, I'll call tax audit risk tolerance. But it's important, even from a general standpoint. How's your CPA handling your taxes? Are they taking an aggressive stance or are they taking a conservative stance? So there's always a continuum, and those should be conversations that you have with your CPA, and it'll give you a sense for where you're at. From a planning standpoint, as tax attorneys, we don't have a lot of call it secret sauce that's real straightforward. If we did, we'd have a line around our door, right? Or it'd be around the block, right? With people lining up to say, hey, Brian, I want you to do this, or I want you to do that. There's less of that in the income tax planning space, but when it comes to estate tax planning, we absolutely do have that. And we're at this period of time, as I started with, my partner and I are completely inundated. We're interviewing attorneys, tax attorneys, to bring them on board because there is so much of this planning going on. And it goes back to the estate tax exemptions that I talked about. So we know that the current estate tax exemption is $11,580,000. All of the proposals have indicated that President-elect Biden wants to decrease that exemption amount significantly, and the number that keeps being referenced is $3.5 million. So what are clients doing? Clients are setting up trusts and they're gifting assets to their trusts. Clients that, we do a lot of this anyways, but over the last, call it month, 4 to 8 weeks, I'll call it, that activity has significantly increased, exponentially increased, and people are doing it. People are setting up the trust. They're making the gifts. People that, we've been talking about for 2 to 3 years, they know that they always should do it. Now they're taking action. This same event was going to occur back in 2010, and then it was going to occur again in 2012 when the exemption amounts were going to sunset. And I don't know if it's because I've been in the business longer, I have different perspective, but kind of the feeling is there are a lot more people taking aggressive action to make these set up the trusts and make these gifts by the end of the year. So there can be a lot of estate tax benefits to making gifts to irrevocable trusts. But then anytime we're doing that, I can tell you the client always says, well, this might make sense from a tax perspective, but what if I ever need my money back? So when we hear irrevocable, people get, you get concerned for good reason. In this day and age of estate planning and trust planning, you can build in a lot of flexibility to your estate tax planning. So I just put up on this slide, a simple structure that's very common that we can use. Where if you're looking at the screen on the left-hand side, I'm assuming husband and wife here. Don't need to be married, but just for purposes of this slide, grantor husband creates an irrevocable dynasty trust for the benefit of their wife and descendants, children, grandchildren. The husband gifts assets into the trust. Those assets are now, you use your $11,580,000 exemption. Those assets are now in trust. All of the future appreciation is outside of the estate. The way that we structure our trusts, we also structure them for estate asset protection benefits. So when the assets are in the trust, if there's ever a creditor claim, a current creditor claim, or after the husband dies, if the wife has a creditor claim or the kids have a creditor claim, as long as those assets are in the trust, we structure our trusts so that they would not be subject to any future creditor claims.
Well, Brian?
Yes,
Brian,
sir.
We're a little over time, so this is fantastic. So I mean, this is.
Can I have 30 more seconds and I'll wrap this up?
Okay, but the one question I wanted, because this is great, is we didn't talk about interest rate. Real estate interest rates. Your mortgage interest being deducted. Do you think that's going to happen or not?
Yeah, so is there going to be a change to the $10,000
Right.
the SALT deduction? I don't know. Biden hasn't talked about it, and everything's headed the other way. Everything's headed. There's more taxes,
Right.
as opposed to loosening that up, which, as we know, also impacts us significantly here in New Jersey.
So finish up what you're doing here, but I wanted to get that in because that affects a lot of us. So
yeah, it's a great question. So real quick to finish up, you make gifts to the trust. The assets in the trust or you use your exemption today. All future appreciation is no longer included in the estate. And I talked about creditor protection. If any of the children ever get married and divorced, so an ex-spouse or a future ex-spouse of a child, a grandchild, the assets while they're held in trust can never be subject to that ex-spouse or future ex-spouse if a child or grandchild gets divorced. And of course, you can get access to the assets in that trust either through your spouse or kids. We also put loan provisions. So you as the grantor, if you needed to get access to the money, you could do so by way of a loan from the trust. So with that being said, I'll wrap it up with, there's a lot of flexibility that you can build into your estate tax planning. And we're seeing a lot of people move forward with executing around these types of strategies.
Brian, there are already people asking about you coming back. So this is fantastic. And so here's his contact information. Please reach out to him. I know you're swamped with a whole bunch of stuff, but as you can tell, Brian is one of the best in the business at explaining this stuff. 973-261-5960.
I should have my email. So my email is easy. It's Brian, BRIAN @singletonllc.com. Feel free, if you have any questions, don't hesitate. Don't worry. You're not going to be on the clock. within reason. Don't, in seriousness, the people I've gotten to know with the Rothman Institute, Dale, you, Tony, Susan, you guys do such a fantastic job. The human beings and the people that are part of your group, I've gotten to know a fair amount of them over the years, and they're all fantastic quality people that have fantastic, great businesses. So if anybody has any question, please don't. I'm easy to get a hold of. You know, we have a fantastic legal assistant. You know, email me. Somebody will be in touch with you, and we can set up a call within a reasonable amount of time. Dale, Susan, Tony, thank you guys so much as always. I'll turn it back over to you.
Thank you.
Well, thank you so much. And Tony, you have your camera on.
Yep. No, I'm good. I'm good, Dale. Just wanted to.
But just thank you very much. This is great, Brian. We're going to have you on Family Business World TV show and probably have you back after, you know, all the chaos of the election is done, and we'll continue this. So take care, everybody. Thank you so much for watching this. Have a great weekend. It should be a good one, and we will see you. We don't have a show next week because that's Thanksgiving, but we do have one coming up weeks after that. So take care, everyone. Goodbye.
Bye.
Thanks, everyone. Take care.
Brian, great job. Great job.